It is time now for our weekly market monitor who likes stocks with good dividend yields. He has names that he says are severely undervalued in this low interest rate environment. Joining us is Jordan Posner. He's Senior Portfolio Manager at Matrix Asset Advisors. Jordan, welcome back. Nice to have you here.
Great to be back.
You're a value investor, bottoms up process, and you like dividends. So let's start with your first pick, which is CVS Health. And of course, their acquisition of Aetna, you say, is a kind of a game changer.
Well, really has reconfigured their business to be a much broader player in healthcare. Just earlier this week on Wednesday, they had an investor day where they rolled out a lot of the strategy and financial guidance for that business overall. And I think it was pretty well received. They're really transforming the healthcare business with a concept called health hubs, which is really taking space in many of their stores and converting them to like an urgent care type of clinic, but with more services and that people can use. We think the stock is very modestly valued at less than 8 times earnings, and has a yield of over 3.5%.
Home Depot, I was looking at a longer-term chart of this company. Now, you're looking for value, but a few years ago, this was a $75 stock. Today, it's a $200 stock. There's still value in there?
There certainly is. The stock is actually down from its high, within the last year. And what's happened there is that the housing market pressure from last year depressed some of their results, drove the stock down. But management there is very focused on shareholders. Now with the lower interest rate environment, we expect that actually demand for housing and home improvement should do much better. The stock is certainly more expensive than some. It trades just above a market multiple at under 18 times, but still pays a 2.8% yield. They're repurchasing stock and will increase that dividend significantly going forward.
Your next pick has a really nice dividend, 6.4% in terms of its yield, and that is AT&T. And you're saying basically that they are a key player with 5G coming up, but also the street is not really appreciating that Time Warner deal that they did.
Right. Now, that, of course, was a big marquee deal. It got a lot of attention, and people kind of thought of it as what could they do with it other than destroy the franchise. And actually, although there's been some management change there, the business seems to be operating quite well, generating a lot of free cash and profit contribution to the company. Now, with that and the HBO business, the Turner businesses together, they're going to be launching an over-the-top service. We think that actually has the potential to be valuable. The stock trades at a very low valuation, under 9 times. And the core wireless business is a terrific franchise, and we think that they continue to operate very well.
On that note, Jordan, thank you so much. Jordan Posner with Matrix Asset Advisors.